So very quickly, I just wanted to cover a double bottom reversal, what it is, what it looks like, how you can profit from it. The double bottom reversal is a bullish reversal pattern typically found on bar charts, line charts, and candlestick charts. As its name implies, the pattern is made up of two consecutive troughs that are roughly equal with a moderate peak in between. So here we have an image of a double bottom reversal. You see the first test down here, you get the trough, and then you have another test down here. And one bottom, second bottom, double bottom. Although there can be variations, the classic double bottom reversal usually marks an intermediate or long-term change in trend. Many potential double bottom reversals can form during a downtrend, but until key resistance is broken, a reversal cannot be confirmed. To help clarify, we'll look at key entry points in the formation, then walk through an example. Key points. Prior trend. With any reversal pattern, there must be an existing trend to reverse. In the case of the double bottom reversal, a significant downtrend of several months should be in place. The first trough. The first trough should mark the lowest point in the current trend. As such, the first trough is fairly normal in appearance and the downtrend remains firmly in place. The peak. After the first trough, an advance takes place that typically ranges from 10 to 20%. Volume on the advance from the first trough is usually inconsequential, but an increase could signal an early accumulation. The high of the peak is sometimes rounded or drawn out a bit from the hesitation to go back down. This hesitation indicates that demand is increasing, but still not strong enough for a breakout. The second trough. The decline off of the reaction high usually occurs with low volume and meets support from the previous low. Support from the previous low should be expected, even after establishing support. Only the possibility of the double bottom reversal exists, and it still needs to be confirmed. The time period between troughs can vary from a few weeks to many months. This depends on what time period you're looking at, of course, with the norm being 1 to 3 months. While exact troughs are preferable, there is some room to maneuver. Typically, a trough within 3% of its predecessor is considered valid. Advance from trough. Volume is more important for the double bottom reversal than the double top. There should be clear evidence that volume and buying pressure are accelerating during the advance off of the second trough. An accelerated ascent, perhaps marked with a gap or two, also indicates a potential change in sentiment. Resistance break. Even after trading up to resistance, a double top and trend reversal are still not complete. Breaking resistance from the highest point between the troughs completes a double bottom reversal. Like advances, these should occur with an increase in volume and or an accelerated ascent. Resistance turns support, broken resistance becomes potential support, and there is sometimes a test of this newfound support level with the first correction. Such a test can offer a second chance to close a short position or to initiate a long. Price target. The distance from the resistance breakout to the trough lows can be added on top of the resistance to break to an estimate of target. This would imply that the bigger the formation, the larger the potential advance. It is important to remember that the double bottom reversal is an intermediate to long-term reversal pattern that will form in a few days. Even though formation in a few weeks is possible, it is preferable to have at least 4 weeks between lows. Bottoms usually take longer to form than tops. Patience can often be a virtue. Give the pattern time to develop and look for the proper clues. The advance off of the first trough should be 10 to 20%. The second trough should form a low within 3% of the previous low, and the volume on the ensuing advance should increase. Volume indicators such as the Chaikin, money flow, OBV, and accumulation distribution can be used to look for signs of buying pressure. Just as with the double top, it is paramount to wait for the resistance breakout. The formation is not complete until the previous reaction high is taken out. So here you go. Here's the bottom. Here's the second touch of the bottom. Here's the resistance. And it's not officially a double bottom until this resistance is broken. You see the breakout, and then you see a pullback. This is your entry, and you can go long. This just explains it. I'll find another example for you. Here's one on the US dollar, Canadian dollar. Actually, this was a big reversal. As you can see, price rallied from that bottom. So, and you wouldn't think so, considering it's not a very big pattern. Excuse me, but this took what, April, all the way to July to form. So this took a long time to form. Yeah, this was a good setup. So we see first test, second test. Good setup. Price kind of staggered at resistance, formed a inverse head and shoulders, it looked like, and then we had the breakout move, and we even had a pullback here, and then just kind of rode this a little bit, and then finally we got this large move up. Shit. But yeah, it's a key reversal, and it was talking about you can project the distance of the breakout by measuring this first low to the resistance line. And you take that and measure that over here. And you can set a take profit to that point. It's just a general guideline. I mean, you don't have to. You can easily just ride a trend up from a double bottom. But yeah, that's about everything. If you have questions, just comment them below. Take care. Take it easy.